It's not an exaggeration when you look at US debt levels, which are unprecedented, when you look at global debt levels that are unprecedented. It is inevitable that we're going to have volatility, crises in the markets, in the economy, from Main Street to Wall Street. So this is something I've been tracking for years. It's only accelerating because the levels of the debt and the levels of the measures introduced to address that debt, what's happening to the currencies, they're all connected. And the measures now since Trump are just getting more accelerated, but the debt problems are still there. And so, again, every market crisis is a liquidity crisis, and every liquidity crisis is a derivative of a debt crisis. And so when you have the US at unprecedented debt levels and the world at unprecedented historical debt levels, we're just a bug looking for a windshield. And that red debt balloon is surrounded by so many needles. In 2019, we saw a market crisis or a repo crisis, which was just a liquidity crisis. Too big to fail banks didn't trust each other's collateral. Repo markets dried up. Fed came in, mouse clicked some dollars, threw some liquidity at a liquidity crisis. 2020, we had the COVID crisis. Stocks and bonds fell together. S&P down 36%. Unlimited QE followed. So you had a liquidity crisis followed by more liquidity, artificial liquidity. Fast forward to 2022, Powell's raising rates higher for longer and his failed war to beat inflation by raising rates. That caused the worst nominal returns in stocks and bonds since 1871. That was a liquidity crisis. Of course, 2023, he had to, at certain points, start to pivot. But then in 2023, we had another liquidity crisis. It was called a banking crisis. But really, that was SVB and First Republic and all the bank failures in 2023. But that was ultimately, again, a liquidity crisis. It wasn't a banking crisis. It was just the bonds that were the underlying bonds in the reserves of these banks had lost value because of higher rates. So that too was a liquidity crisis. And you fast forward to today, or the markets we've seen in the last week, and the extreme swings and the VIX at 52 and intraday trade moves of greater than 10% up or down. That is a screaming sign of another liquidity crisis. In other words, the grease necessary, the dollars, the treasuries necessary to keep a debt-based market and a debt-based economy rolling have all dried up. And so when we're looking at this, and we can get in more weeds of what Trump's effects are and the tariffs effects are, or what the Fed's response is going to be, or what the dollar is doing, it's very complicated, but it's all very simple. All of it stems from a country and a world over its skis in debt and not enough liquidity to match that debt. Certainly not enough natural liquidity from growth, GDP, tax receipts, productivity, the normal things that would keep the grease and keep the engines moving on Main Street and on Wall Street. All of that's drying up because there's so much debt, there just isn't enough grease. And the only way to solve that liquidity crisis, as we saw in 2020 or in the repo crisis or in the banking crisis, is more liquidity. And that, of course, is inherently inflationary at the end. You can have deflationary moments like a market mean reversion or a recession, but the solution is always throwing more liquidity at a liquidity crisis. The problem is that liquidity is man-made, it's mouse-clicked, it's synthetic, it's highly inflationary, it debases the currency. And so you have a currency crisis at the same time as a debt crisis. And even what we're seeing on top of all of that, to add insult to injury, what we're seeing with the weaponization of the dollar in 2022, which was, again, I've said it 1,000 times, the greatest mistake ever made in U.S. foreign policy or the State Department, by weaponizing the U.S. dollar and the FX reserves of a major power like Russia. The BRICS have risen. The data for that we can get into is undeniable. The de-dollarization trend is undeniable. So at the same time that we're having a liquidity crisis, not enough liquidity to cover debt, the world is slowly but clearly moving away from the US dollar and the US Treasury. So that adds insult to injury. So there is a liquidity crisis, a geopolitical crisis, a currency crisis. And we can talk about how that ties into the markets.